Welcome back. You're watching the ET Money Show, and we're going to talk about a very important subject. Now, quite a few of you have credit cards, and quite a few of you use those credit cards actively. And there are some of you who pay the minimum amount and cycle that to the next month. Now, this is not necessarily a very bad practice, but sometimes payments are missed and things kind of spiral out of control and you fall into what is called a debt trap. I want to talk about this in a lot more detail because this is something that can have far-reaching consequences in your financial lives. Talking to me right now about debt traps and everything debt is Amit Kukreja, who is joining me now. Amit Kukreja is the founder of Amit Kukreja Advisory. Thank you so much, Amit, for taking the time. A bit of a sensitive topic and something that is equally important, though. Let's talk about debt first. Debt isn't necessarily a bad thing, right?
Yeah. No, absolutely. I mean, debt means you are trying to take advantage of your available credit line to solve a life problem that you have at hand. And money is a means, it's a resource. So you can borrow the money to solve your problem at hand. And debt can be very powerful in terms of leveraging that money, the borrowed money, to bail you out from that life situation or a life problem. So debt does not necessarily mean a problem area. Debt is a leverage. Debt can also be considered as power. And debt just needs to be carefully analyzed in terms of paying back to the lender. So I think that's where the problem begins, when we completely ignore the consequences of borrowing money.
Let's talk about how a debt trap happens. How does somebody fall into a debt trap? What do you call a debt trap, first of all, and how does someone fall into one?
Sure. So, debt is considered good only and only if you have the capacity to pay it back. If not in lump sum, then gradually in equated monthly installments back to the lender. So what happens when you borrow money? Sometimes you could be in a situation where you have a very high credit line available and you borrow the money, but suddenly your life changes and your paying back capacity diminishes suddenly, which means the borrowed money cannot be returned. And when you try to borrow from other sources to return the other borrowed money, you end up having more debt. So a debt trap could be a vicious circle of borrowing money to settle your older debts and incurring more and more interest cost in your financial system or in your financial capacity to pay it back. And that's where it becomes a double-edged sword, where you not only have the burden of a borrowed money, you also have the burden of the incurred or accrued interest on the borrowed money because of the situation that you have got stuck with. If you do not get stuck in this situation and you maintain your capacity through your salary, through your business income to give it back to the lender, then debt is powerful. Then you are creating a leverage. If you're borrowing money to solve a problem, or to borrowing money to buy an asset which is appreciating in nature. So I'll elaborate more later based on your other questions.
Absolutely. In your experience, though, is this something that is very easily done, in that it's very easy to fall into a debt trap? Because if you have, for example, a line of credit in the form of a credit card, and I'm illustrating things here, you've spent a certain amount of money. There is an emergency for which you do not necessarily have funds readily available, but you swipe your card and you utilize the extent of the credit that you have, and you don't have the ability the next month to pay that back. You revolve it slightly and you push things as far as possible, but then another thing happens and you have no control over that. So is it very easy to fall into a trap like this?
It's very easy to fall into a trap like this when you do not have control on the flow of your money. Sometimes people do not consider the ability to give it back to the lender. They just consider the available credit line, and they take the risky call of using that money to take a punt or gamble or do an investment in a business or any other investment where the risk is very high and the probability of reward is not very high as much as the risk is. So debt trap can be a vicious stage. You just need to be very careful about your paying back capacity, and you should not gamble with the borrowed money. if you keep that principle in mind that I don't need to borrow, I don't need to ever gamble with the borrowed money, I don't think one can ever fall into a debt trap as long as he has the payback capacity.
Talk about different types of debt differently. In that, would you rate different types of debt differently? Would you look at credit card debt separately? Would you look at personal loan separately, a mortgage separately? How do you classify this?
Sure. So I would say there is a good debt and there is a bad debt. A good debt is something where the money is borrowed to to be used on an appreciating asset. So a home loan or a mortgage is a good debt, provided the home loan, provided the price of the property that you have purchased is increasing with time. And generally, we have seen the real estate appreciation is matching inflation or can be surpassing inflation if held for a period of 8 to 10 years. So that's a good debt because you also get tax efficiency on the home loan. But if you're borrowing money on a depreciating asset like a car loan or a motor vehicle loan, then it can be a bad debt unless the borrowed money or the card that you have used with the borrowed money is falling into a taxable business expense and is giving you a tax advantage. Otherwise, it's a bad debt because your asset is depreciating. The worst loan is the credit card loan. That's the terrible loan that's having interest cost of about 28 to 36% per annum. And that's where the available credit line, which looks very tempting to the borrowers, can be very, very problematic to a borrower if the borrower doesn't have the capacity. And I call that an extremely bad debt. If somebody is borrowing money on a credit card means he has explored all the options, he doesn't have any choice but to borrow it on a credit card. And that's where it hits his credit history the most. So credit card loans must be avoided at all costs unless you're very certain that the borrowed money can be paid back within the stipulated period of 24 days or 28 days, whatever is the billing cycle of the credit card.
Okay. I'm glad that you've classified this. Now let's talk about what happens if an individual falls into a debt trap. It's important to talk about how you can extricate yourself because a lot of times this financial worry is coupled with a lot of emotional turmoil as well. So, how does one deal with this in a pragmatic, step by step manner?
And sorry, repeat that part, Alex, again.
How
does
does
one deal with what?
Yeah, so I'm saying when one falls into a debt trap, not only do you have a financial difficulty, a financial problem, there is also a lot of emotional turmoil and there is a propensity then to make bad decisions. What I'm asking is, how does one deal with this in a step by step pragmatic manner?
Sure, sure. And as I always give, to every problem, there is a dual way of responding to the problem. One is a left brain approach to solve the problem, the other one is a right brain approach to solve the problem. The left brain approach is the logical approach, the black and white approach, and the right brain approach is the creative approach where emotions are at play, right? So the first thing, let's manage the crisis emotionally. Let's manage the crisis in a manner that we are not getting too stressed out or getting depressed about the debt trap. And I know it's a very, very natural way to fall into that state. Let's give it a shot through left brain. Let's see where all we can borrow this money. Can we borrow the money from friends and families? Do people trust us? If yes, then we can borrow the money from friends and families and tell them that we will pay it back to them in a timely manner and use that money to pay back the debt. Start with paying off the most expensive debt, which is the credit card debt. Then move on to the less expensive debt. This could be a personal loan debt, personal loan, or it could be a motor loan. Then move on to the tax efficient debt, and you don't have to pay back the home loan immediately because home loans are lenders are still little more considerate if you have a very sticky job situation. So you will have to go through this crisis and see whatever support you can gather from your friends and family and deal with it. And at a right brain level or an emotional level, you have to be confident, you need to be positive that things will not aggravate into a bigger problem, and keep doing the behavioral change of making sure that the flow of money is in your control. The temptations to buy or spend money is really, really controlled. And also you maintain a budget going forward for all the incomes and outgoes so that you do not repeat this mistake. That's my 2 cents on managing it.
Come to that because I mean, I'm not saying that all such situations are caused because of behavioral tendency, but sometimes that is involved, the propensity to spend, because it is proven that when you go out and spend and you buy something, you feel good, you feel happy. And you want to make yourself happy, you want to reward yourself, but sometimes you tend to go overboard. So, are there behavioral changes that you need to take up? Sometimes, maybe, would you say that it's important to seek guidance and help also?
Yeah, very often this happens. And let's fast forward the situation where you have bailed yourself out from this financial crisis, and now you are making a note of the lessons learned from this episode in your life, right? So the first thing you would do is, what is it that led me to that crisis? You need to evaluate and understand that you don't do that mistake. And sometimes what led me to that crisis could be prevented in future by going through some of the habits that I might have had, which were detrimental to the way I was using or managing my money. So understand your habits, understand your impulses because of which you ended up borrowing money. Was that a borrowing to gamble somewhere, or was that a borrowing to deal with a lifestyle expense, or was that a borrowing to meet a genuine financial goal that you had, and it was a circumstantial situation where due to loss of job you ended up failing returning the money back to the lender? So you will have to analyze and evaluate what led to that and see how that thing cannot be repeated. Lessons are always learned in crisis, and crisis also make you a better person in terms of managing the risks in life. So certain minor things I would suggest is maintain a budget for your expenses, identify, classify the non-negotiable needs, the discretionary needs, and the investments that you would do. Make sure that you have a contingency fund set aside and you are never ever splurging your contingency fund, even if you are realizing that the fund is not being used. Make sure you maintain a good control over expenses and incomes. Make sure you value money. Make sure you don't reward yourself if you're borrowing money. Make sure you're rewarding yourself if you're not borrowing money. So do these minor modifications and make a note of the lessons learned, and see if you can evolve with time and avoid these mistakes that you did, which led you into a vicious debt trap earlier.
Incremental changes, as they say. Very quick last question, and I know that there is no one-size-fit-all solution, Amit, but I'm asking this so that people have a reference point. How much is too much as a threshold in terms of your interest payments or your repayments on debt as a percentage of your monthly income?
Yeah, good question. I'm glad you brought it up, Alex. Two things I want to keep in mind. I would like my viewers to keep in mind. One, make sure your solvency ratio is 3, which means the total asset value that you have and the total loan. So divide total assets by total loan. It should be 3 or above. So if you have 3 crores of assets, make sure your loans do not go beyond a crore, in simple words. In terms of payback capacity, make sure the maximum EMI that you have in your post-tax income does not cross 40% of the total post-tax income or your enhanced salary. So if you maintain a solvency ratio of 3 and the max EMI capacity not going beyond 40%, I believe you will be in safe hands in terms of your financial situation. And that should always help you not to fall into these debt-ridden situations ever in life.
Thank you so much, Amit, for taking the time. This has been an insightful conversation. Always a pleasure.
Thank you, Alex. Thank you.
All right, that brings us to the end of this conversation, but there's more on the other side of this very short break. Do stay tuned.